The market is at a critical inflection point. This is a data-driven game plan, and we're going to focus on the key levels that will likely determine the next big move.
All right, let's get right into it. The market is completely fractured. You've got this tug of war between some really bearish economic data and, on the other hand, incredibly powerful bullish seasonality. The tape is telling two different stories, and the question is, which one wins?
And that brings us to our first section here. This is truly a market on edge. The uncertainty is palpable, you can see it in the numbers, and positioning shows a huge division in conviction. So the question that every single trader is asking is pretty simple. Are we looking at a major market top forming, or is this just a healthy, needed pullback before we get the next leg higher? Well, the data actually gives you arguments for both sides.
Let's focus on the big shift in rate expectations. Just a few weeks ago, a December rate cut was practically a done deal. Today, the CME FedWatch tool has those odds down to a coin flip, 50-50. That rapid repricing is what's driving a lot of this volatility.
And this slide really shows you the market's fractured psychology. The NAIM exposure index, right? That's what the pros are doing. They're 90% long. Meanwhile, you look at retail sentiment gauges, and they're screaming extreme fear. This is a classic divergence, and one side is about to be proven very wrong.
So let's build on that and look at the case for caution. There are several signals popping up that suggest a more defensive posture is probably warranted right now. Okay, 3 major warning signs are now active. First, we've got a cluster of 5 Hindenburg omen signals. That's a technical indicator that flags conditions for a potential crash. Second, you have the capitulation of a famous bear, Michael Burry, which historically can be a great contrarian signal. And third, the VIX is back above 20, which puts us in a higher volatility regime. The labor market's also showing some real cracks. According to the Challenger Gray data, this past October saw the most job cut announcements in 20 years. Now, this is a forward-looking indicator. It suggests an underlying weakness that the official, backward-looking government data might not be showing us yet. And this brings us to what I think is the biggest risk, a Fed policy error. As Stephen Mirren put it, the Fed is using backward-looking data, a recipe for getting policy wrong. The real danger here is that the Fed stays hawkish, looking at old inflation and jobs numbers, and keeps tightening policy right as the economy is starting to roll over.
But like I said, there is a powerful counter-argument. So let's flip the coin and look at the case for a rally.
Right now, there are 3 big bullish catalysts in play. 1, the government shutdown ending removes a major piece of uncertainty. 2, you just can't fight the powerful seasonality. Q4 is historically the strongest quarter for the Dow. And 3, there is a mountain of cash sitting in money market funds. That's potential fuel just waiting to come into the market.
This whole macro conflict is really playing out at the sector level. So let's drill down and look at the key sectors you need to be watching.
The tape shows a really clear rotation happening right now. Money is flowing out of laggards like tech and small caps and into new leadership. Healthcare, that's XLV, just had a major technical breakout, and your key support level now is $148. Financials, XLF, are outperforming, and they have strong seasonality at their back. At the same time, small caps, IWM, are still weak, below their moving averages, with critical support right around $238. Honestly, this rotation is the most important story on the tape right now.
So how do we take all this conflicting information and make sense of it? We do it by defining very clear scenarios and having a plan for how to posture for each one. Okay, here are 3 potential paths. Our base case is that this choppy sector rotation just keeps going, with leaders like healthcare holding their breakouts. The bull case is that seasonality wins out, and the trigger for that would be small caps, IWM, reclaiming their 50-day moving average. And then there's the bear case, a Fed policy error. That scenario gets validated if XLV fails its breakout and closes below 148. And IWM breaks its key support. Just a quick and important reminder, this content is for educational purposes only. It's designed to help you stay informed and improve your own decision-making. Please do your own research. This is not financial advice. Now let's translate these scenarios into a couple of actionable, risk-defined strategies.
So the first setup is bullish on that rotation theme we talked about, targeting the healthcare ETF, XLV. The thesis here is simple. Continuation of its technical breakout. A debit call spread gives you a risk-defined way to play for more upside over the next 1 to 2 months. The whole thesis is validated on a close back below that 148 breakout level. And the second setup targets the laggards, specifically the Russell 2000 ETF, IWM. Here, the thesis is that this persistent weakness could lead to a breakdown of that key support level. A debit put spread lets you take a bearish position with a clearly defined risk, exploiting that potential underperformance. This view is invalidated if IWM can reclaim and hold its 50-day moving average.
And of course, the mandatory warning: options involve substantial risk and are not suitable for all investors. Your capital is at risk and losses can exceed the premium you paid.
So I'll leave you with this question. Is this rotation we're seeing into defensive sectors like healthcare a warning sign? Are institutions getting prepared for a downturn? Or is this simply the healthy, necessary leadership that's required to carry the market to its next leg higher? The levels we've talked about will give us the answer. And please, if this data-driven analysis was valuable to you, a like and subscribe really helps. It signals the algorithm and helps this content reach more viewers. Your support is very much appreciated. And one last time, this is not trading advice. It's just a market update to keep you informed. Markets carry risk. You have to trade your own plan, manage your downside, and always, always verify all data.